Welcome back. In this video, we are going to understand some common corporate actions. Corporate actions are actions on the share capital of the company that have a direct impact on the shareholders. These actions are proposed by the board of the company and approved by the shareholders. At times, companies also require the approval of the market regulators. Corporate action includes sharing the surplus profits of the company by paying dividends or buybacks, also known as share repurchases. Or corporate actions may include changes in the capital structure through issue of bonus issue, rights issue, and mergers and acquisitions. Let's look at these corporate actions one by one. Starting with dividends. Dividends are share of profits of the company received by its shareholders. A company may declare dividends more than once in a financial year, but they are allowed to declare dividends only out of the profit and loss account. Also, the dividends can only be paid out of the profits of the year in which the dividend is being paid. Hence, a loss-making company cannot make dividend. It is the board of the company which recommends dividend, and it requires further approval from the shareholders. The next corporate action is buybacks or share repurchases. In a share buyback, the company buys some of its shares listed on the stock exchange. The company buys these shares from its reserves and surplus account on its balance sheet. The shares bought back are extinguished by the company, and it leads to reduction in its share capital. Since the shares bought back are extinguished by the company, so the number of shares outstanding are reduced. This essentially leads to an increase in earnings per share for the remaining shareholders. In order to be eligible to offer a share buyback, the company should not have defaulted on its interest payments, loan repayments, or dividends. The next corporate action is a bonus issue. A bonus issue of shares is made to existing shareholders of the company. As part of the bonus issue, the existing shareholders receive new shares in a certain proportion at no extra cost. For example, a 1:3 bonus issue would mean that each existing shareholder will receive one extra share for 3 existing shares held by him. A company is eligible for a bonus issue only if it has not defaulted on its interest payments, dividend payments, or loan repayments. The next corporate action is a rights issue. A rights issue involves giving the existing shareholders the first right to buy new shares issued by the company. If a company decides to issue new shares in order to raise capital, it affects the existing shareholders adversely. This is because this action reduces the percentage holding of existing shareholders. In order to avoid this, companies go for rights issue to existing shareholders. This allows the existing shareholders to buy the new shares before they are offered to others. If the investors do not want to buy more shares, they can sell their right entitlement to others. To facilitate this, right entitlements also get traded separately from the shares of the company. The last corporate action is mergers and acquisitions. Mergers and acquisitions deal with buying, selling, dividing, and combining different companies and similar entities. Mergers and acquisitions can help an enterprise grow rapidly in its own sector or in a totally new sector. The term merger refers to legal consolidation of two companies, which leads to formation of one new entity. The term acquisition is used to refer to a situation when one company takes over another and completely establishes itself as the new owner. Mergers result in creation of a new entity, while acquisition results in one company buying the other and no new company is formed. With this, we have briefly covered the various corporate actions. In the next video, we are going to look at some important dates associated with corporate actions. So see you in the next video.